Good morning, everyone. So happy to see you today. Thank you. Thank you all for joining our education class today. This is our first live class. So you're the most important audience to us. Okay, keep coming. And my name is Pauline Lam from Cotai Realty. I have the great honor to serve as your 2025 Education Committee Chair. Firstly, we wish to express our gratitude to all the victims suffered from the devastating wildfires in their thoughts and prayers. WSGVR President Ingber and leadership has sent an email to our member provide the resources and valuable helpful information last week. Please do share this information sent from membership at wsgvar.com to our members for those who need help. Thank you. A few housekeeping tips before the class starting. Please silence your cellular phone. If you need to answer the phone call during the class, please walk out through the hallway. Please keep this door open and access from this door during the class if needed. At this time, I would like to introduce our keynote speaker today, Ms. Nicole Green from Robert Hall and Associates. Nicole Green is an enrolled agent with nearly a decade of experience in tax industry, holding a federal license to advise, represent, and prepare tax returns for individuals and businesses. Her expertise has been featured in publications like the Wall Street Journal, Homelight, and Impact.com. With a master's degree in education and a passion for lifelong learning, Nicole thrives in navigating the complexity of the tax law. Outside work, she loves travel, enjoy global cuisine, attending sporting events, and more. Please help me to give a very, very warm welcome for Nicole Green to present 2025 tax strategy. Nicole.
Thank you so much, you guys. Thank you so much for your patience. I'm good at taxes. I'm not good at like GPS and maps and all of those things. We're gonna get right into things just because we are a little pressed for time. Okay, you guys know already a little bit about me. As she said, I work at Robert Hall and Associates. We're a tax firm. We do really everything one-stop shop type of deal, but we focus on tax because tax strategies can change everybody's lives. People want to make more money and get more money, but the government will come around and ask you for more money the more money you go and get. So it's not really about making more money. Yes, you need to do that, but it's also about keeping your money that you go out and make. And that is all done with tax strategies. And one of the real reasons why I greatly enjoy taxes, and I know it's so weird, I love tax, but one of the reasons why I love tax is because it puts all the different aspects in the financial world together. And so here at Robert Hall and Associates, we've been around since the 70s. We were started by Robert Hall himself. Him and his wife were educators. I'm an educator. We truly believe in education, and that's how we help people, because there's different strategies that can work for you, but it's all about what you want, and you need to understand what's going to fit your lifestyle and what's going to work with your goals. There's not one way to do things. And so when we give people different strategies, we like to make sure that they go out and do it as opposed to just talk about stuff. And so we do a lot of stuff in-house. The things that we don't do in-house, we have a great referral system so that we're able to refer out to people. But we do, incorporation, tax planning, obviously payroll, accounting, we do it all. We kind of want it all to be inside and a good home. First and foremost, again, we're great, strong believers in education, and we offer free consultations to people. The free consultations are a great way for people to sometimes just get a simple question answered. It's so often I run into people and they'll be like, actually, I just had this question. I can't get a hold of my accountant. Can you answer this question? And it's so easy for us to answer that I understand that it's a little difficult sometimes for people to get a hold of them. And so that's why we offer these free consultations. It's 30 minutes. You can sit down with someone and then you can go over the accounting. We can see if what we would do for you, what we would recommend is a good fit for you, or if you just have like a general type of question. There's several times I sit with these appointments. People give me their tax returns and they're like, I think my accountant is just messing things up. And I'm like, no, they're good. Let me explain why they're good. Like which is nice that somebody can have like a second ear because you might feel like, hey, this is really bad. And it's like, maybe it was presented in a bad way, but it actually isn't really bad. Or you might not know that something is wrong. And we can say the exact opposite. We can be like, hey, by the way, you're doing this. This is really aggressive. Or, hey, by the way, maybe you shouldn't do this. We're able to give that second opinion. And so that you can have actually a little bit of alternative advice when you're doing your taxes. And also, if you have a direct question that I'm not able to answer today, please feel free to email me, nicole.green@roberthalltaxes.com. Nicole, not green. It's super easy. Okay, I just want to let everybody know as a little announcement here. I'm an enrolled agent. I do taxes. I'm not a real estate agent. I'm not a broker. I'm just giving advice based on the tax side of things. Okay, let's get into it. We've got a lot of changes that are going to happen in 2025. Obviously, we're going to have a new administration. A new administration always means changes, like 100% of the time, it means changes. And if we can go with what this person did in the past years, there probably will be significant changes. What those changes are, I don't actually know. We don't need to wax on about hypotheticals because so much stuff can get stuck, like stuck in our own bureaucracies. So let's talk about things that are actually happening. And one of the first things we want to talk about is BOI. That is the beneficial ownership information statement. It was very, very there was a lot of noise about it last year because this was the first year that it went into effect. Several people had some issues with the BOI, and so they took it to court, as many things do, and it has now been put on hold. It is actually not effective at this moment. If you want to participate in BOI, you can. It is no longer a requirement. What is BOI? BOI was an additional bit of reporting. That's all it was. It was reporting if you have a business, if you have an EIN, and it's not for a trust, and it's not for, if it's not for a trust, and it's not for, like, if you had a bank or something like that, you would have to do what is called the BOI. You're just identifying who you are, who the owners of the business are, and so that they would understand who everything is going to, and then your EIN and the address. The State Department, not the state, California, but the State Department is looking for money laundering, is looking for foreign ownership. There's different things you have to do when there is foreign ownership, and they want to make sure you're doing said things. And it's just another way for them to track. Unfortunately, or fortunately, depending how you look at it, our government agencies do not speak to each other. When they speak to each other, they're very, very angry and they're going after you quite hardcore. And so, and so because they don't speak to each other, sometimes you have to do repetitive things. And this BOI is the same thing that you have to do with actually California. Every year when you have a business, you have to fill out your Secretary of State information, right? Your SOI. It's that exact same thing, except for a different agency. But right now, it's on hold. It's elective. If you want to do it, you can do it. Okay, so our everyday expenses. One of the biggest ways that people can help themselves is to incorporate things that you're already spending. I have people that come up to me and they say, hey, Nicole, should I buy a car? I heard I can write off the whole car if it's 6,000 pounds. Maybe I should buy a boat. The answer is no. The answer is no. If you're spending money to reduce your taxes, you're still going to be spending more money than whatever the taxes that you're trying to save. And so it's not good to be spending more money unnecessarily just because we don't want to give some of that money to the government. You're still out more money. And so the goal is for you to incorporate all the expenses that you can as deductions so that you can reduce that income that is taxable. And so there's some really great ways to do that. One of those great ways to incorporate your expenses is to understand how you're set up. Are you set up as an LLC? Are you set up as an S corp? Are you set up as a C corp? If you're depending on how you're set up, making sure things are registered correctly and understanding where your expenses lie. When I have clients that are a little conservative or clients that are new to working with an accountant, I have them create a P&L, like a profit and loss statement for their business or for their rentals or for whatever it may be. And then I also have them create one that is personal. And so then I can understand what are the expenses that they have that can be incorporated into their business. People are thinking like, oh, well, I'm not going to put my gas or my car. And I'm like, if you're using your car for business, you absolutely can include your car. Depending on how your setup will determine how we use your car. But when I started asking questions, I'm like, well, what about maintenance? What about, your toll charges? Like, what about parking? You sure paid parking at least once this year somewhere. Like, incorporating all of these small expenses. Sometimes people think, oh, they're small, it doesn't really matter. Yeah, but if you have 50 small stuff, that actually does add up. And why aren't we including something that you already spent anyways? Like, why aren't we adding it? And so we want to make sure you're including everything that you have. Then it comes to actual large items. And that is where we have depreciation. Depreciation is when you take the value of an item and you take that value of the item and you spread that deduction over a particular period of time. This is not determined by your accountant. This is not determined by the IRS. It is determined by accounting rules that everybody has agreed to work with. And these accounting rules determine how long something is depreciated for, how fast it can get depreciated. It determines all of that. And so commonly we can think of it like as a house, right? If I have a rental property, because when you depreciate something, it can only be a business use. And if I have a rental property and I bought my property for easy numbers, let's say I bought my property for $150,000. Not here, but let's imagine I bought my property for $150,000. My property, I paid for the land and I paid for the building. So I can only really depreciate, let's say about $100,000, probably a little bit more, but for easy numbers, $100,000 of that. That $100,000 is going to be divided amongst 27 and a half years. It's going to be spread out. And so I will be getting a little bit more than $2,000 a year of a deduction. And that's for 27 years. Now, when you initially buy something, you can do something special. You can take what is called bonus depreciation or special depreciation. And that is where you take a little bit more of something in that first year. And that's where things can get really, really fun because you can really start to accelerate some types of things. Because if I'm having this $2,000 deduction every year, $2,500 deduction every year, that's great. But if I can go ahead and have maybe $70,000 of a deduction in 2 years, now you're going to really see my tax come down because I have this huge deduction and it's going to reduce my my taxable income. And then I will have a year or two with very, very low tax. And the way you can do that is through what we call a cost segregation. A cost segregation is where you're really maximizing bonus depreciation. And so right now, maybe in the next 2 years or something, you're going to see a lot of movement happening with people in terms of buying real estate because obviously the fires. Several people are not going to be able to rebuild on their own. And so they're going to be selling things. And then that's going to have a lot of investors coming in. And it's going to be a great opportunity for everyday persons to come in and stuff. And so rentals are really going to be great in California. It's going to really be a great opportunity. Doing a cost segregation study on a rental will be very, very helpful. You take your rental property, and the specialist will come in and they will itemize that rental property. Remember, with depreciation, different items have different timelines that you depreciate something. You take the deduction over different timelines. With the rental property, as in my old example, I said that was over 27 and a half years. With a car, you depreciate that over 5 years. With windows are 10 years, air conditioner is 15 years. You get my point. Certain things have different timelines. And so if I have my house, you're just going to lump it all together as 27 and a half years. However, if I have a specialist come in and itemize everything, now I've got some things in 5 years, 10 years, and 27 years. And I am now able to accelerate, take that bonus depreciation and move it forward. And so I am now able to get that $70,000 of a deduction in 1 or 2 years, all with a cost segregation. Now, keep in mind, when I'm talking about real estate, there's two different types of real estate ways to think about. One, if you're able to get the deductions with passive losses, or if you're not, but we can get a little bit into that later. I want to show an example you guys can see here. So with this one is actually, oh, sorry. This one is actually without the cost segregation, okay? This is just a general return without the cost segregation. You can see that you're showing $33,000. I don't know if I have a, you can see up there where I circled, we're showing $33,000 of rental income. That $33,000 is taxable. And so my total tax in this situation was 20,850 on the federal side. I did some withholdings and I got a credit. And so I ended up owing $4,000. And then on the state side, I also ended up owing about another 4,200 and so dollars as well. And so with now, if I had done the cost segregation study, that cost segregation is going to have me have that depreciation, so I'll be able to have more of a deduction. And you can see that with that larger deduction, my rental income actually ends up coming out to a loss. My rental income actually ends up becoming $11,000 loss. Sorry for my super large circle. It becomes $11,000 loss because I have more of a deduction. That $11,000 loss takes down all of my income. And so I went from having a 20,500, I think it's 20,800 and some odd dollar total tax to 11,000 right here of total tax. And I don't owe, I also get a $5,000 refund. On the state side, it's going to be just the same as well because of the cost segregation. On the state side, again, I am getting now a refund of $1,300. Right there, I already saved myself $15,000 of tax because of this accelerated depreciation that I chose to move forward. This is one of the best things that people can do, especially when they want to grow their portfolio. This is all about growth because you take this tax savings, you take this $15,000 of tax savings. Keep in mind, depending on the property you buy, if you buy a more expensive property, like if you decide to do this in California, you'll have a more expensive property, obviously. And you have more expensive property, you'll be able to have a larger deduction. With this is just kind of like a simple basic. The with this cost segregation, I save the $15,000. I take that $15,000 tax savings. I go invest it. I have, again, I'll have probably another $15,000 of tax saving next year. Now I have $30,000. I take that $30,000 that I have from 2 years. I go buy another rental and I do the same thing. You rinse and repeat, and you never have to put in new money. You just are doing your tax savings and then going to get another, and then going to get another, rinse and repeat, rinse and repeat. Cost segs are really great ways for regular everyday people to be like developers. They can go out and continuously grow their portfolios. I had a client that was like, I can never afford to get a rental. And I'm like, I'm looking at your income. You can absolutely get a rental. And then he was like, I want to get a fourplex. And I'm like, okay, you can get a fourplex in 3 years. He didn't believe me. I said, go buy a small, single family home for $500,000. He went and did that. We did the cost segregation. On year 2, he had enough money, not from saving anything, just saving his taxes. He had enough money to go put it down on his fourplex. So he had a single family and a fourplex right there, which is even better. Now he's thinking about doing a 1031 into even a bigger place, which is a whole other situation. But he's a person that went from going, I'll never be able to afford a rental, to actually, you now have 2, and one of them is multifamily, all turning a profit, of course. Like, don't buy something that doesn't turn a profit. That's just. At the end, I'll ask if you guys have any questions, so we can go back into the cost segs and stuff like that. One of the other big items that people talk to me about is the dreaded audit. And what are they going to do that's going to cause an audit? Because they say, I don't want to do anything that's going to cause an audit. I don't want to do anything that's going to cause an audit. I understand. Nobody wants to deal with an audit. That's absolutely awful. Even if you have an audit and it ends up being what we call a zero change audit, meaning they audit you and then we prove that you're wrong for auditing them and everything we did was correct. Zero change audits happen all the time, but still the stress of being under audit. And so there's a couple of things that trigger audits, and there's a couple of things that people need to be very, very cautious about when they're doing audit. Obviously, the more aggressive you are, the more likely somebody's going to come around and ask a question. And that's what an audit is. It's the government going, this doesn't make sense. Prove it. That's all they're doing. It's just going like, I don't understand how this is happening. Prove it, which, okay, we can do. But so the more aggressive you are, the more likely you're going to have an audit, which doesn't mean you shouldn't be aggressive by any means. It doesn't mean that at all. You should prepare yourself. And there's ways to sure things up. So that's what we call it. You call it suring yourself up, so that if somebody does come around, we can go real quick and be like, here. Here's all the paperwork. Here's everything. Go away. And so when you know you're going to do something that is more likely to cause an audit, you could be better prepared. Because again, the audit might be just zero change. So let's talk about just general things that cause people to get audits. These are 4 red flags that are just no, like just no. Excessive credits and deductions compared to income. And so this is one of the things I was talking about earlier when I said your deductions really determine how you're set up. Whether you have an LLC, whether you have a S Corp or a C Corp, a single member LLC, sole proprietorship, or it's just nothing. It's just you. This is really important because some things are more likely to cause attention than other things. Let me give you a really, really clear example of why. So on your personal, let's imagine I have a small business. I sell microphones. I'm a tax accountant and I sell microphones on the side. My selling of microphones on the side, I just put that on my personal return. I don't do anything. I'm not incorporated, whatever. If I were to incorporate with my selling of microphones, the amount of paperwork that is required for the business return is a lot more significant. And so if the IRS has questions about me selling my microphones, They have paperwork to see it right there. You can't attach that same paperwork to a personal return. There's just nowhere or place to do it, and you're not allowed to add attachments unnecessarily. And so when people have individual returns, they need to be very cautious about the amount of deductions in comparison to their income. Because if you're taking a deduction, the IRS knows what's going on. They're like, oh, okay, you're trying to reduce your tax. Maybe it's justified, that's totally fine, but maybe it's not. And so, like, when you see people on their personal return and they have, like, let's go back to me and selling microphones. If I have $10,000 of income, but I have $50,000 of expenses, $40,000 come from? Like, that came from somewhere. Where did that come from? If I was incorporated on a business return, I have to identify that. That's just part of the return. I have to identify with the balance sheet what's going on. On a personal return, there's nowhere for me to show with that 40,000. And that looks bizarre. Like, why do you have this without that? The amount of work, there's a little bit more work when you're incorporating. And so the amount of work definitely means you're going to be a little bit more focused on the business side once you have incorporated. And so understanding how much income and then how much expenses you have in comparison. You don't want to have things completely skewed in when you're incorporating things. If they are just generally because it's the first year of business, because whatever the reason, and it's totally justified, there's different ways to go about it. Maybe we depreciate some of those items because maybe I bought a bunch of microphones that I'm going to sell. And that's why I have, $50,000 of expenses. Okay, so I should spread those deductions over, 5 years so that I can keep those deductions, but I don't trigger an audit. Also, credits are the same thing. If you're rolling in a lot of credits, a lot of people saw audits when they were taking those ERC credits, PPP loans. Like, you saw lots of people coming around because they want to make sure you're doing things correctly. Missing and underreporting income. This one is also quite significant as well, because you need to understand that the IRS has many ways of knowing how much money you make. We're one of the only few countries in the world that have it skewed where they know how much money you make and they want you to tell them. They want you to prove that you're being honest with them. And so when you forget types of income, that's really, really significant because they think you're hiding or lying. And none of those things is great. And so when I get people that will come to me and be like, hey, I also have an ADU in my back, but I don't want to report it because it's always no. We have to report it. And actually, usually, most of the time, they're hurting themselves by not reporting it because they missed depreciation and they had expenses for that. And so we can reduce their income. And so reducing the income by reporting more income is actually something that happens quite often. And the IRS also knows when you're not reporting income, you're relying on somebody else, whoever gave you that income, to not take a deduction. Because if they get audited, they're going to show the IRS or the state, hey, I did pay this. I gave it to Sally Joe. And then they're going to go, the IRS or the state will go look at Sally Joe's return to see if you reported the income that your customer said that they had. And so it's one of the dumbest things. You need to report all your income. There's other ways to reduce your tax than hiding income. There's better ways. Next big one is refundable credits. There's two types of credits. There's non-refundable and refundable credits. And sometimes a credit is split into two, like the child tax credit. It is split. Part of it is refundable, part of it is non-refundable. Refundable credits mean that you'll get a refund if you don't use the whole thing. Refundable credits are huge because the IRS might say, fine, no problem, we'll give you this deduction, we'll give you a credit. But when they now actually have to come out of pocket and give you money, that's a whole other thing. Like, if you think business owner aspect of it, somebody has a complaint and they want a refund, wouldn't you much rather give them a credit as opposed to giving them back the cash? Yeah, of course you would. And so that's the same way with the IRS. They would much rather give you a credit than giving you back cash. And if people that qualify for refundable credits because it's free money, it's literally free money, they are going to be more aggressive about making sure you are correct and you qualify for said credit. The next one and the last one is round numbers. Nothing costs $25. Nothing costs like $200. That's just, that doesn't happen. That just doesn't happen at all. You can buy a house for $500,000, but you've got all the transaction costs, you've got the commissions to the agent, you've got the taxes, da, da, da. So it never comes out to a round number. And so when people give you or give me these things that are like just round numbers, I'm like, you didn't do it. You didn't actually go in and get the work and actually look at your expenses. And the IRS knows that too, because they're it just doesn't happen. Like it just doesn't happen with tax involved and everything. Nothing is round. And so when people just, oh, $25, 300, 4,000, no, 4,550. No, like that's not how it is. And they know that you're just making things up off the top of your head, maybe an educated guess, but still, it's a guess. And they don't want you to guess. They want you to actually go in and look at your receipts, look at your numbers to see how much you spent. Those are really, really important. And so these are the four things that really just catch people off. And once you get audited, once you have the IRS or the state come around and say to you, hey, something looks funny, they're going to look at everything. And so you don't really want to open the door. Like we want to just keep that door closed as long as we possibly can. If we are going to risk the door opening, it needs to be for a good reason. It needs to be because you're saving yourself $50,000 of tax. Okay, maybe we can risk it because we're going to get a good savings. And then we'll do some really important things to make sure that if we do get audited, we'll be able to pass the audit with zero changes. That's also very, very important. Now, again, I talked earlier about the different types of entities, whether you're an S corp, a C corp, and LLC, sole proprietor, etc. Because it's again important to know what you are and how you're set up, because the amount of audits will happen differently based on those types of entities. Those types of entities have different reporting requirements. Thus, the IRS has more or less information depending what they are. So a partnership is going to, the percentage of audit is going to be 0.1%. It's not very high, while an S corp again also 0.1%. Why? Because there's a lot more paperwork that I'm required as a preparer to send with your return. And so that's also like why people charge more to do these returns, right? Because I can't, it's not the same. I have to do more work and I have to ask you more questions. I have to go get more paper. Like it's a whole thing. It's more work, which I'm happy to do. Don't get me wrong. And so they have more information, so they have less questions. So they're audited less. C corps are also going to be audited a little bit more because sometimes people do C corps incorrectly, because people are very afraid of double taxation with C corps, because that happens often, of double taxation. And so they'll pull money and not report it, or they'll call it a loan and it's not really a loan. And so there's some common things that happen that people do incorrectly on C corps that cause the audit. Personal returns. And this is single member LLCs, this is sole proprietorships, and this is nothing. Like, whether you have your rental in a LLC or you have, your business inside, a single member LLC, those are disregarded entities. You're literally telling the government, don't really call it an actual entity. And so it's all going to be on your personal return. Thus, you're going to be audited 0.38% of the time, because people mess up all the time. Like people are like, oh yeah, I drive Uber and I made $10,000, but I'm gonna put my car, I'm gonna put everything on there, and I'm gonna take a $80,000 deduction. No. Or you make no money and you want to take like a $30,000 deduction. People do that too. And that's like, no, what are we doing? Like, it's very frustrating. But there, that is going to be more likely to cause an audit. It doesn't mean all personal returns are going to cause an audit. It's the personal returns with like businesses and funny things that are happening in it, type of thing. Um, Also, something for people to understand about audits. People say, like, oh, if I make too much money, I'm going to start to trigger an audit. Yes, people that make very little bit of money are going to try to start to trigger audits because they most likely will qualify for those refundable credits, right? Those credits where you're getting that free money. And so that's going to what's going to stem those audits because I don't get any credit. But also, if you're making over $500,000, but why? Because once you hit $500,000, there's a lot of things you can do to significantly reduce your tax. The people that are in 150 to 500,000 or 475, whatever, of income, taxable income, life is so bad. That's the worst. It's the worst. There is things that you can do to help reduce your taxable income, but it's going to be, you're just reducing your tax, you're making sure you're set up correctly. Once you hit that $500,000 mark of income, or $500,000, including if you're adding in your properties that are included in there. There's other things you can do: conservation easement, fee simple donations, DB plans. There's a lot of things you can do, which maybe you don't want to do because you don't like certain levels of risk, or you don't want to lock some money up, whatever it may be. But there's more options for you if you want to be maybe a little bit more aggressive and save some significant amounts. And again, aggressive is not bad. You just need to make sure that you're doing something for value. Like, if we're going to be aggressive, we're going to save some good tax, like good money. Year coming up. We're going to skip QBI. That's something. Okay, I'm going to go really quickly with this because I want to get to the last bit where I'm talking a little bit about the fires, because I know that that's a big thing that people are very concerned about because, obviously it's been devastational. Okay, so the top types of deductions. First, marketing and advertising expenses. Marketing and advertising, if you have a business, if you have a rental, if you have anything where you're having outside consumers come in, and you are providing either a service or a business, you are now doing it in person and online. So you are operating on two fronts. So if you look at your marketing and advertising expenses 8 years ago, you're probably double or triple that. Not necessarily because you've grown, but because you have more fields that you need to operate on. If you're a realtor, you have the signs that you were doing, and then you're also having to market everything online and paying for all of those expenses, all of those fees to be a part of this network and to be a part of that network and stuff. So marketing and advertising expenses are huge. Very, very large deductions coming from that. Professional supplies and equipment. This one is also very big. If you were blessed enough to be able to work from home during COVID, a lot of people had to rebuy everything, because now that COVID's over, they have two different places that they have the option for working from. Again, because things went online so much, it requires people to have multiple items that we originally had one for. And so these supplies, if you're buying extra computers, I have a TV in my office at home, I have a TV in my office at work. And these are expenses because I use these TVs for work. And so these are expenses and deductions that I can be deducting for things. Another really large one is car expenses. Constantly, I'm telling people these are too low. Look at averages. These numbers, when people are talking about miles, when people are talking about gas deductions, because how you take your car expense will change depending on how you're set up. but you want to think about industry standards, and people forget a lot about their car expenses. And this is one of the largest expenses people have, especially here in California, because the average American drives a little less than 10,000 miles. The average Californian drives 14,000 miles. We are significantly more on the road and we have more expenses. Also, because we're in the road a little bit more, our cars are usually nicer than other people's. And so, again, that's an additional expense that we have for people. Legal and professional services. I see this all the time. I look at people's P&Ls and I'm like, where's the money you paid me? Like, they forget the money that they paid their accountants. They forget the money they pay their bookkeepers. If you're getting a notary, if you need a consultant to come in, a transaction coordinator, all of these professional expenses. And sometimes they're one-offs that you're not really thinking about. You bought a rental property and you wanted to get a really specialized inspector, or you just wanted to have a conversation with a designer. All of these things are professional expenses and services. I don't care that you just sent them a Zelle. Like, that's fine. It doesn't mean you need to actually have a full formal invoice for it. But if you are paying for these professional services, it is a deduction, and we need to include it. And then, as I spoke about, property deductions. Once you own property, this is one of the best and largest deductions that you are able to take. Depending how you want to use your property will determine how you actually want to choose which path you can go down in taking these deductions. Depending how your family life is set up will also help with these deductions. Whether we're doing cost eggs, 1031, there's bonus, special depreciation. There's a lot of things you can do with property. You just need to sit down and take a little bit of a minute to go with it. Okay, let's talk about the fires, and then I'm going to open it up to questions. So with the fires, a lot of losses happen. It's been absolutely devastational, obviously. And people are really trying to consider, what am I going to do? How much is this going to cost me? And how am I going to be able to rebuild? In terms of insurance, when you're able to use your insurance payouts and when you're not, obviously that's a little bit down the road. If you decide not to use your insurance, or if you decide just to call it a wrap, you're going to be able to take what's called a casualty loss deduction. And that deduction is going to be able to reduce your federal income. California will conform with this casualty loss deduction as well in some specific cases. Now, a casualty loss deduction is going to be dollar for dollar what is lost. Now, the way you can compute what is actually lost is one of two ways. And unfortunately, they're going to take the smaller of the two ways. You either look at your adjusted basis, and that's the money you've put into the property. I bought a property for $500,000 and I did a little bit of reno, and so now I'm at $600,000. That is my basis for this property, $600,000. My insurance paid me out to rebuild this property $300,000. I'm going to be able to take that difference, that $300,000 difference, as a deduction, because I put in 600 and they only paid me half. And so I'm going to be able to pay the difference, because let's be honest, the insurance is not going to pay. Nobody is going to be whole at the end of this when it's all over and done with. I mean, unless you, whatever. There's another way that they can also calculate your loss. Again, you bought the property at $500,000, but the property is worth $750,000. The property is worth $750,000, and the insurance again paid you out at $300,000. So now we have a $450,000 of a difference. In those two situations, you're only going to get that $300,000 loss. If it was flipped and the insurance you bought, your property was valued at $750,000 and the insurance paid you $500,000, you would get that $250,000 of a deduction. You have to calculate both of those what your adjusted basis versus your loss, and also your value of your property versus the loss. And then whichever one of those is lower, you will take that lower one as a deduction. But let's imagine you bought your property. Yeah, I bought my property at 500,000 and the insurance decides to pay me out $600,000. If now I have $100,000 of gain, depending how I use that money and what I do with that money will determine if it is taxable. If you do not rebuild with that money in that time, it can be considered taxable. There are certain time things with insurance payouts that will require you just need to be of note. These fires have been declared a federal disaster, so it gives us double the normal amount of time. So you'll have 4 years from when you have that insurance money to make that decision. Not 4 years from the fire, but 4 years from when you actually receive that money. And if you want to go ahead and put it back into your property, then that money will not become taxable within, depending on how much it is. If it's over 500 and you've lived in the property long enough, then it won't be taxable. But there's details that go with it. But in general, if you get more money than you actually paid for something, that difference is going to be taxable. What's really important in times like this and for property owners to consider is to consider the value of the property. As soon as you're able to get property assessments, formal assessments, not, oh, well, my neighbor said their house was this. No, actually get an assessor. That's going to save you a lot. Getting formal assessments of before the property caught on fire and after. People can go back in time and do retroactive assessments. So whoever is assessing your property today, be like, I need you to also tell me what the property value was, last Tuesday. And they can actually go back and do that. You need those two differences by a licensed person, and there's different types of people that can do it. I highly recommend the property tax people not to be the one because they always value properties pretty low. Just FYI. But you can get like realtors. There's a bunch of people. There's assessors that actually do that just as 100% their job. There's a bunch of people that can go ahead and get that done for you. But those two things are very, very key. And then you're able to take those deductions. But again, you do not want to take your deduction now. It is not going to be a 2025 deduction. You want to make sure you understand what the insurance company is going to do. Because if you take your deduction now, my property, I bought it at $500,000. It is now worth $10,000. I want to go ahead and take, that $490,000 today. And then lawsuit happens, blah, blah, blah. Now my insurance is willing to pay me $600,000. All of that money is now going to be taxable. And having large amounts of taxable income added onto your income is going to be intense. And so you really want to wait until the insurance decides what they are going to do. And the insurance also will be very great at getting you a list of items that are valued inside your house that can help to reduce the gain. And so people that are really rash and want to go quick with, recouping their losses and things like that, they're the ones that get hurt the most in the taxes. Okay. Couple of things that people need to make sure that they do. We already talked about the replacement gains. Couple of things that people need to make sure they do is they keep really clean records, detailed records. The stuff you're sending your insurance person or the itemized deductions, the itemized list of things that were inside your property is something you need to maintain. You need to maintain that. If you pay people for your property, whether you're paying people that because you are in Altadena and you have to get the land treated, or you're even paying somebody to just give you some advice, you need to keep record of all of those things. It's very simple to ask somebody for an invoice. They can write an invoice on hand, or they can print it out very, very easily. Also, These California fires are obviously specific to California, but most of the stuff is just for federally declared fires. But in California, there will be probably additional relief that is offered. What happens on the federal side and what happens on the state side sometimes is not the same. And so it's very important that you understand that it's going to be state specific. It's California specific, not county specific. And lastly, everybody in Los Angeles County has been put on automatic extension, meaning your filing deadline, whether it's your company, whether it's your personal return, as long as it's not a fiscal year company return, has been extended to October 15th. That does not give you an extension to pay. That is just an extension to file. It's very, very important that people know for 2024, you should have already paid your taxes. You were required to pay your taxes by the end of 2024. If you didn't, you would start to get penalties after April 15th. But interest accrues starting January 1st, 2025. But penalties accrue after April 15th, but penalties will start after April 15th. But your extension to file is going to be October 15th for businesses and personal, unless the business is on a fiscal year. Okay. Okay. That's it. That's all I want to talk about. Again, here's my email. If you guys have additional questions, feel free to send me an email. You can sign up for a consultation. But if you have questions right now, do we have time to take a couple of questions? Y'all have questions?
Any questions? Can you come up to the mic, please?
Oh, it's so formal. I love it. It's like we're in City Hall.
What's the AI's impact on the IRS audit?
I'm sorry?
Artificial intelligence?
Yes.
The IRS is going to use it. And what's the impact on?
So the IRS, so when we file electronically, the way it happens, you file electronically, the IRS gets the information, they press print, and people do it by hand. The IRS is not about to use AI until a whole new system comes in. They don't have the technology for such. They don't have the technology for such, and the government hasn't regulated it. Yeah, I'm no.
Thank you for the information that you provided today. I have a question. My tax return been hold from the IRS for the past 4 years. First of all, what is the reason that they're holding the my refund for that long, and how can I go about to get my refund back at this point? We did receive something that saying the check or something, but we don't even know where to go from this point on.
I have questions. Is it an amended return?
It's what?
Is it an amended return?
Amended meaning?
Meaning you did a return and then you said, oops, I made an error and I want to change it.
Oh, no.
No, it's an original return.
Correct.
Was the refund significant?
Yes.
5 figures or more?
I think 20,000.
Okay, 5 figures. Did you get the state return?
I did.
You did, but not the federal.
Correct.
It sounds to me like the check was sent and was it a direct deposit or was it a check?
Direct deposit. I only got state, but the federal, and try and contact my CPA, but they said, okay, call this number and
Send an email and we can sit down and I can tell
Sure.
you we can find out why. That's easy.
Okay, thank you.
Yeah. That's easy to find out why. Because you should have got that. You'll get interest if you haven't gotten it. You're accumulating interest. I mean, they follow prime. So the last 2 years is good interest, but before that it was crap. Just saying.
Thank you, Nicole, for coming over today. Give us lots of information. I have a question. I filed my tax return last year, but they e-filing, but they said that I haven't filed, and it make my health insurance go up right away from last December 2024. And when I go to IRS system and also Social Security system, all of them, they say I haven't filed my 2023 tax return. So I make an appointment today, later this afternoon, to go with them. And my question is, if they have the confirmation of receipt of my e-filing, why they did not have anything of my thing on the system?
You made an appointment with whom?
My personal tax return. I
You said
sent,
you have an appointment today?
yeah, I make the appointment with them because,
With who? Who's them?
with IRS.
No, stop.
No?
Stop. We don't want to talk to them. Stop. No. You need to talk to whoever. Did you file your return by yourself?
No, from my CPA, with my
From your
CPA.
CPA?
Uh-huh.
So you need your CPA to issue to the IRS, and I'm going to tell you to have them do it because when, as a licensed professional, we get to talk to the IRS faster than you can. And so it's much more, there's a whole separate system for us than what
Right.
it happens for you. And so it's a little bit faster. They need to send the IRS confirmation of receipt. It sounds to me like they might have electronically filed it, but it didn't actually go through. And so they need to send a receipt that it was, because right now, if you go, they're going to tell you, if you speak with the IRS right now, they're going to be like, yeah, we don't have it. What do you want us to do? And then they'll be like, give us a copy of the return, sign it. And then you'll give them a copy of the return. You're going to sign it, and they'll use this date as submission. And so you'll get late filing, late payment, under filing, and I'm missing one. There's 3 penalties: late filing, late payment. There's one more. I'm missing one of the penalties. Anyways, there's 3 penalties: that failure to file. There it is.
Wow.
Late filing and failure to file penalties. And if you filed on time, no, we don't want those penalties. And so you need the CPA that filed it
Mhm.
to give proof that it was filed on time.
Okay. And I asked my CPA twice, but my CPA, they hire a future CPA, which means, they have,
Mhm.
they're ready to go for the CPA exam, but they're not CPA yet. Those people to handle my file. And
What?
well, he ought
You
to
wanted
say,
that discount.
yeah, I want to make that.
Well, you got what you paid for.
Maybe I have to make appointment with you after this. Yeah.
You you paid them money, correct?
Well,
Oh God.
I last year, I was supposed to pay last year, right?
Yeah.
And then in December, because of my insurance go up so much, then I checked.
So you haven't paid.
I haven't paid. I
Okay,
didn't know,
so
but
this is
I
what you
could
need
pay
to do.
something.
This is what you need to do, because right now you have no recourse. And so let's say your CPA right now goes, I'm not dealing with it, whatever. Blah, 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 blah. You're going to have to go to the IRS, and you have no proof. And so they will take today's date as the filing. And I don't know how much income is going to be on there, but if we're talking about 2023, you're already looking at well over $6,000, $7,000, $8,000 in penalties already, and not even talking about yeah, and so that's just the failure to file, like, yeah. And so you'll have no recourse if you pay them. So I would write them a quick check. And they walk away. You can now go to the IRS and be like, look, my CPA ran off. They are licensed. And so the IRS will then go after that CPA for that $6,000 that you don't need to pay. And so but you only can do it if it's a paid service. You have no recourse if it's a non-paid service. And so my first thing would be to tell them, hey, I need proof of filing. If you can get them to give you proof of filing, if you don't trust them anymore, I would be like, at a minimum, give me proof of filing, and then you can go to somebody else and they can fix it really easily. If you still trust them, tell them to fix it. They know what to do. Fix it.
They gave me the confirmed e-filing receipt. See, Tanya, we filed it on this date. This is the confirmation on April 15, 2024.
Is it an actual, it looks like it
An
looks
email.
but is the receipt just a letter that's written up, or is it actually like it looks like what do you call it? The old school computers?
Oh, Isn't like that they gave me free documents. Yeah, one of it is the receipts, confirmation of receipts of my filing. And then the other two, one is my tax return, and then the other one I forgot what it is. Yeah.
Okay. I think you need to work with somebody else.
Yeah, that's what I
I-
think.
And I think you need to pay.
I was, last year, December, when I noticed this, then I checked my information and then I
Is
go to
this the
IRS.
state too?
Well, in April 15th, I sent a check something, prepay. I sent the prepay.
And they refunded it.
Yeah, and then I got some refund.
Yeah.
And but for the total amount, because this CPA, every time I have to ask him, can I have my copy
This
of
is a
that?
mess.
Yeah.
Yeah. You just need to have somebody clean it. It's possible to get it cleaned. It definitely is possible to get it cleaned. You should not be patient anymore. You need to either have the current CPA that you had use it, go ahead and handle it and get it cleaned, or you need to go to somebody else.
Okay.
You're welcome. I would not recommend you talk to the IRS.
Oh, okay.
That's like a doctor doing surgery on themselves. Like, nah, you can't. Nah, like you're gonna say something incorrect.
Okay.
Like
all
you
right.
might say something like, "I didn't pay them," and oh god, they're no, like, and then they're like, "Oh, really? Okay," and yeah, all the onus would lie on you.
Okay.
Yeah.
All right.
So
okay.
I would cancel that appointment.
All right. Even today.
I would cancel that appointment. I would cancel that
Okay.
appointment.
All
If
right.
you need an appointment, you can just call.
Okay. Thanks so much.
You're welcome.
Thank you.
You're welcome. Yeah. Thank you.
Let's give a big round of applause to Nicole. And on behalf of West and Gabriel Valley Realtors, we present you a certificate and small tokens. And so we want to take a group photo after the class, okay? A little announcement. Please continue to join our education classes, especially arranged for all of you. Our next live class is next Thursday, January 23rd, starting from 10:15, right after Emma's breakfast meeting. And Feng Shui Master Alexi will bring us very important message. Right? Yeah, come. It's alive. Come, okay, here. Enhance your luck and boost your earning in 2025. But I think it's not only this. We need to listen what he talked about this year's feng shui and weather change, where to alert, right? Last year, he told us the earthquake come, okay, came so often. Okay, let's dive and thrive and grow together in 2025. And thank you everyone for your joining class today. Invite all of your realtors come to our lovely Western Gabriel Valley Realtors education classes. Let's have a group photo right now. All right.